Hello, and welcome to Adam's Swing Trading Masterclass. Today is unit number 4, which is the long-term core component of the masterclass where we look at the stock-to-flow ratio. Disclaimer, any views or opinions in this course are strictly my own. I'm not a financial advisor, and this is not financial advice. Tactics, strategies, philosophies, and fundamental principles presented here are mutually exclusive with material presented by the other professors. This is because my methods target different goals using different data. So, first up, macro view and price signal. To perform any type of analysis in a correlated cryptocurrency market, we must start at the highest level. I believe that begins with the stock-to-flow model. A solid understanding of future probabilities allows us to formulate rational expectations which inform things like our timing and position sizing. This analysis is what I call the signal and is the foundation of the enhanced long-term philosophy used in my swing trading. Extracting signal from Bitcoin data is the work done behind the scenes to gain an understanding of what price probabilities we are faced with moving forwards. So this slide here is extracted from unit number 1. You can see that what we're going to be looking at today is based on the fundamental laws of economics and a mixture of that and on-chain data. If you're thinking back to that unit 1 lecture, we're going to be trying to move down this list here in sequence and then go back to the beginning again to do the systemization at the very end of the masterclass so we can tie everything together. So the learning objectives today, what is the stock-to-flow ratio? Stock-to-flow model as a price estimator and the stock-to-flow criticisms. So what is the stock-to-flow? Quantifying economic scarcity. Traditional long-term valuation. For traditional financial assets, such as stocks and bonds, it has been fairly easy to approximate a fair price for the asset as a function of its expected future cash flows. Because Bitcoin doesn't generate any cash flows, we have to find another method of modeling its value. I'm just going to give you a quick primer here in economic supply and demand, which will give you a little bit of an idea of what we might be looking at today. This isn't directly applicable to what we're looking at, but it'll get your mind in the right space. So if you have never seen a supply and demand model before in economics, this is pretty much what it looks like. We have a demand curve and we have a supply curve, S0, D0, and we have price and quantity here on the two axes. What happens is if we have a sudden reduction in supply, the supply curve moves to the left. What this does is it moves the equilibrium market clearing price from point 0 to point 1, which means that if the demand curve doesn't change and there's no change in the wealth or the ability of people to purchase more, they have to purchase less if there's less supply. Not only that, but the price also rises. So you can see here that changes in supply dynamics can affect the market price and the quantity. This can work the other way around, where you have an increase in supply and that lowers the price as well. And you can have shifts in demand and supply all over the place. But essentially what we're looking at is the equilibrium. And the equilibrium moves around and shows us where the market will appropriately price that commodity or asset. So gold is expensive because it's scarce and in demand. But dirt is worthless because it's abundant and useless. So you may be asking, this all makes sense. But silver is also scarce. So why is the price of gold always higher? This can be explained with a supply and demand chart, sure, but it would only give us the instantaneous market price of the asset and would be mostly useless at forecasting future value. Thankfully, we can go one level deeper and model its approximate market value in advance using supply data. You can see how this would be useful for estimating the market value of an asset with no cash flows, such as Bitcoin. This is an economic principle relating to the total existing stock of an asset relative to the supply rate of new units flowing into the market. This relationship can be thought of as the total stock relative to the newly created flows, or the stock-to-flow ratio. So, just again, stock is the size of the existing stockpiles of reserves, and flow is the new yearly production. And this, we're going to do an example here. When this model was originally applied to Bitcoin in 2019, gold had a stock-to-flow ratio of 62, meaning it takes 62 years at the current production rate to get the current gold stock. Silver is the second highest with a stock-to-flow ratio of 22. This high stock-to-flow ratio makes them monetary goods. Keep in mind, it is very difficult to have a commodity with a high stock to flow ratio because if anyone hoards the asset, it becomes more scarce. It goes up in price, then production increases to take advantage of the higher prices, increasing the flow and bringing the price back down again. This is what happens to platinum and palladium. You can see here a very low stock to flow ratios because the flow, it only takes 1 year. One year can literally see here of flow to match the total stock. So you can see the market is very reactive to the commodity. Bitcoin. If you've gone through the starting materials, then you'll already know Bitcoin's supply rate cannot be accelerated. Therefore, there cannot be an increase in production in response to investors hoarding the asset. With Bitcoin, a shortage of the asset usually results in higher prices, often dramatically so. Furthermore, this supply rate is predetermined for at least the next 100 years, meaning that while we cannot predict the future demand function for Bitcoin, we can know the supply function with certainty. And this is what it looks like. In this one chart here, we essentially have the Bitcoin stock, which is a cumulative measurement. We can see here it goes up very fast and then flattens off into the future. And then we also have the flow, which is the inflation rate, newly minted Bitcoin, and it reduces over time. You can see here it gets cut in half in these different eras. This is approximately in the 4-year halving cycles. And yeah, we're to the best of my knowledge, we're in the 6.25 block reward era right now. And so yeah, in this one chart here, you've got the stock and the flow. So we can make a function out of that and essentially determine the stock to flow. Now you can see here within each halving era, it's not exactly smooth. We have a bit of variability in the inflation rate due to hash rate being added and taken away from the network, and the difficulty adjustment constantly oscillating to try and manage the inflation rate to get it as close to its average as possible. So it's never going to be perfectly flat because the Bitcoin network itself can't adjust that fast, and the hash rate's constantly jumping in and out. You can see approximately it sits, at its predetermined rate. It just moves around a little bit. So when we go to this chart here, which is the pretty much the foundational chart of the stock to flow ratio, it's kind of explains why there's variability in the stock to flow ratio. When taking into consideration that the inflation rate has a little bit of noise in it, so it will vibrate from side to side along this axis down here, and then the Bitcoin price itself. As the price of Bitcoin and the market cap itself moves around, it will oscillate up and down on this axis as well. The most interesting thing is when you actually look at the stock to flow ratio for any one particular month, and you look at the market value for any particular month, and you start to plot those together as a relationship. All these dots. And what happens is if you put a regression through these dots, you find it has a very strong linear relationship. What's even more interesting is that once plotted, you look at gold and silver up here, they sit very close to that linear relationship on that line as well, which at least initially suggests to us that not only does Bitcoin have a very strong relationship for its market price to its stock to flow ratio, but so does gold and silver. Great signs there. And so this is one of the foundational charts for the stock to flow ratio. I won't go through all the advanced maths to try and figure it out again to explain it to you guys. You can do that in your own time if you're interested. We'll go just one level deeper here. And this was the stock to flow cross asset model, where algorithmic clustering was brought in to essentially group the Bitcoin stock to flow ratios in each halving era. And you can see the green dot up here is the approximation of the stock to flow ratio to the market cap value for this era that we're currently in, placed on this linear relationship. And in this one as well, which was done a year or so later by 100 trillion Plan B, you can see that silver, gold, real estate, and diamonds also have a very close linear relationship, which is just all super fascinating. And all the little red dots in the back here, you can see gold yearly values and the gold cluster very tightly grouped over here, which is a fantastic example of that relationship between the gold market value and the stock to flow of gold being very tightly correlated. So yeah, if we can look and we can say, well, using the inflation values, using the stock and the flow, we can essentially get a stock to flow ratio here, and we can say, okay, if we know what it is and we have the linear relationship, then what is the market value? We go over to the side here and we say, well, if the market value is such and such, and we know exactly how many Bitcoins there are in circulation, then logically we can derive the estimated price, which is the next thing that we're going to be looking at. So stock to flow as a price estimator. This was the original stock to flow ratio plotted as like literally a price chart where we have, you can see here the purple line in the background. We would have the halving events where the value of the stock to flow would jump up quite quickly, and the variability is representing the hash rate moving around. So then we have big jumps, and the price is kind of attracted to that. And you can see that's the idea behind it anyway, that every time we have a halving, we have a supply shock that's reflected in this stock to flow ratio, which in turn drives the price up in order to sterilize that imbalance between supply and demand and have that scarcity reflected in the price of the asset. You can see over here that we're currently just below the predicted stock to flow ratio for the original model, which is the most conservative one out of all the different models. There's a couple, but there's only really two major ones that we'll be looking at. And you can see here, this is the second one, the cross asset model. So whereas the first one has an equilibrium price of about $100,000 per Bitcoin, the cross asset model has a equilibrium price of about $280,000 to $300,000 per Bitcoin. And of course, one of the interesting historical features of the price as well is that it seems to overshoot the stock to flow ratio in each era. Now, whether or not it'll actually get to that or go past it, that's subject for debate. You can see here that we might have diminishing returns for each era. It goes far above the stock to flow over here. It goes quite far above over here, but not very far above here, at least with the cross asset model. With the original one, the relationship's a little more better. A little more tight. We have an overshoot here, an overshoot here, a decent overshoot here. We might just hit the line. We might only see Bitcoin to $100,000 or $200,000 at its absolute peak. But yeah, it's a good way of approximating what the supply and demand dynamics of Bitcoin look like over the long term, because we can't know the demand unless we are like gods and we can look into the psychology of the market and know what every single participant is doing. But using the supply dynamics, which are known, gives us a great base to work from to try and figure out where things are moving. So what we're going to do is we're actually going to think about how we can apply this to trading. So obviously, if you remember this from one of my earlier videos, what we're trying to do is we're trying to find positions in the Bitcoin price where we have the absolute most upside potential available to us. This will enable us to take on more risk, or maybe change our position sizing to better reflect a high probability opportunity that can also make a high magnitude gains. So, for example, these two squares down here are places where I would be looking to incorporate the stock to flow model to see whether or not we have an outsized opportunity to make money. Over a long enough period of time, this is kind of what we're looking for. We're looking for these spots here. Thankfully, using the stock to flow model, we have actually a pretty good model of looking at that. So if we actually take the price of Bitcoin and plot it against our expectations of the stock to flow, we can get a stock to flow multiple like this. It's like an oscillator that moves around zero, which is the predicted Bitcoin price. And we can see areas where the Bitcoin price is far higher than predicted and also far lower than predicted. And this can give us good examples of places that we should be paying attention. Here, I've done my best to line up the charts so that you guys can see where exactly I'd be looking for opportunities to add large sizes to my positions, especially if I was swing trading to have my conviction very high. You can see here that I've got the green lines linked into locations where the price has declined below the stock to flow model equilibrium line. And the historical hit rate is being quite good, obviously. There are some criticisms, though. Criticisms that this model is overfit and that it's just a sheer coincidence. So we'll have a quick look at that. Future projections. Because the inflation rate of Bitcoin is destined to hit zero eventually, with a stock to flow ratio of infinity, the stock to flow ratio therefore predicts a final price of infinity. Clearly, this is not correct. Logically, at some point, there must be diminishing returns to scale. Whether this happens slowly over time or suddenly at some point in the future is unknown. We have to take this into consideration, that there may be diminishing returns. Significance and cointegration. There have been many mathematicians who have run different analysis on the different variations of the stock to flow model to find that there is no cointegration between stock to flow and price. This essentially means the stock to flow model cannot be disproven and may be coincidental. As a result, it falls outside the verifiable scope of the scientific method. And as we all know, the scientific method, one of the core principles of that is that for a theory to be taken as law, it must be able to be disproven. Failure to do that means that you cannot take a model seriously. However, these are a few comments from one of the mathematicians, statisticians that did most of the work on proving and disproving the stock to flow model. Even if stock to flow ends up being garbage or another rainbow chart, there are plenty of other reasons Bitcoin will continue to outperform every other asset. There is no stock to flow, there is no model, there is only rocket fuel. The model may be correct in principle, but it can never be proven. Now, if you're thinking about all this and you're thinking, well, this sounds pretty grim, Adam, and I'm not sure if I can trust it anymore. The thing is about the stock to flow model is that it's a tool. It's a tool in our tool belt, but it does a great job of conceptually explaining why the Bitcoin price does what it does. And it takes into account all the variables that you would logically think would make the price react. It takes into consideration the constriction of supply. It takes into consideration the total available supply of Bitcoin. There are more advanced models that take into account lost coins and coins that are basically, locked in wallets forever that can't be recovered. And those models are pretty interesting to look at as well. But it's just another tool in our tool belt. Essentially, what we're going to be doing over the course of this swing trading masterclass is collecting as many different models as possible. So even if one breaks, then we'll be able to revert to another one. I still believe wholeheartedly that this model is actually very useful. Conceptually, I think it makes perfect sense. And I know that the diminishing returns will absolutely come into it over time. Looking at the stock to flow cross asset model and how much higher it is than the original model, I'd say it's probably a bit too optimistic. Let's be honest. We might enter a phase of the Bitcoin maturity where we just have extended market cycles that just go a lot flatter out into the future like this instead of having huge run-ups. And as a result, most of the volatility may move down into small caps. But that's something that we can look at into the future. Essentially, we're just looking at this and saying to ourselves, how can we use this as a good tool? You can see recently, we actually had a huge amount of deflection away from where the stock to flow predicted price should be, which to me screams great buying opportunity. Whether or not it's perfectly accurate, I think that it makes a lot of sense. With that being said, prepare for unit number 5, where we keep expanding our price model toolkit. If you have any questions, please jump into the crypto general chat or crypto questions and hit me with the @ tag. Thank you very much, guys. Talk to you soon.